You're listening to Mortgage Lending Mastery. Get the knowledge you need to advance your mortgage practice quickly and efficiently from Jen Du Plessis, America's Mortgage Mastery mentor with over 37 years of experience and over $1 billion in lifetime fundings. Jen has been mentoring loan officers and realtors for over 15 years and speaking on stages across the globe. So settle in and get ready as Jen and her guests share their experience, passion, and strategies to help you crack the top producer code to reach new heights in your business. And now, here's your host, Jen Du Plessis, Mortgage Mastery Mentor and head chick in charge of Kinetic Spark Consulting.
Hi, everyone. Welcome back to Mortgage Lending Mastery. I'm your host, Jen Du Plessis. And I just want to say, if you're watching for the first time or you're listening for the first time, welcome. Welcome to our community. And thank you so much for taking time out of your day to spend with us so that you can improve and grow your mortgage or real estate practice. And if you've been listening for a while, thank you so much for your patronage. I really, really appreciate it. Today on the show, our guest is Kevin Crichton. He is the CEO of EMM Loans LLC, which is based out of, are you based out of New Jersey?
Yeah, we're in Cherry Hill, New Jersey.
In Cherry Hill. Oh, and I know Cherry Hill very well.
Yeah.
I used to be with World Savings.
Oh, we see the Philly skyline from our building. So
Yeah,
we're basically a Philly-based company, but in Cherry Hill. Yep.
Yeah, I love it. I love it. And they do $3 billion a year in retail and wholesale production, and they're licensed in 40 states. So that's just a quick part of that. But Kevin, he is, again, the CEO. He's been a leader. He's held numerous positions in his 35 years in the mortgage business. And today, what we're going to be talking about is not only just learning a little bit about EMM loans, but also what your predictions are. What are you seeing? You've been in it for 35 years. You've seen some ups and downs like we all have, right? Who've been in it for this long. But we want to talk about what some of your predictions are. There's a lot of angst in the market right now because things have slowed down after COVID. And now what do people do? Now, what did they do? And we're looking towards 2020. So I want to say thank you so much for joining us today. And thank you so much for taking time out of your day to share your wisdom with us.
Sure.
Yeah. So let's get started with sort of the state of the union. What's it been like for EMM over the last year and a half to 2 years? And maybe take us back to 2019 when everyone was singing the blues about whether or not they should be in the business or not. Yeah. And then bring us forward.
So the best word to describe it is different. Yeah. We came into 2020. We didn't know what the next step was. We had winter upon us. And then, March came here with the pandemic or at least the start of one, which no one really knew how bad it was going to be. And we sent everybody home. So thank goodness for our company being technology driven. That 2 years prior, we had set up the company to be able to go home for a disaster. Flood. We thought of a flood. We thought of a hurricane. We thought of a fire. We didn't think of a pandemic, but we were able to maneuver through it. And we had the best year of our careers in the company's history, and it was smooth. I mean, it was really smooth. The people stepped up in the company. Our teammates stepped up. Everyone did their job. Everyone did it while they were watching children and dealing with the concern over the pandemic. And it was really an amazing and different, like I said, different environment. So we've proven that that we can do it from anywhere. We had a corporate office up till about last, August, so probably April, that we had much more space, much more costs. We were planning on moving out anyway, but we got into a building that is, a serious amount of money less, much less space, much less cost, but yet we don't need to have everyone in the office. So we just have some essential workers coming in and people who feel like coming in from time to time, like they feel like interacting with people, but that's still dangerous. So we're still concerned about, COVID. But 2020 was a phenomenal year from a standpoint of production. And a standpoint of earnings is probably the better way to describe it, because 2 billion to 3 billion, you're doing 2 billion plus now, but yeah, we're not making the same amount of money we were back in 2020. The margins were out of control. They were just every time you turned around, you could add I hate to say it, you can add more margin. It was very super competitive, but at the same time, people were falling over each other to buy a house or refinance or whatever it was. So it was a miraculous year from an earnings standpoint. Yeah.
Yeah, no. What have you seen in recent months? Because I just got back from a non-QM conference in LA a couple days ago, and there was this terminology of softening of the market, and my opinion was, well, no, not really softening. I think we're going back to where we were. Right. Okay, so let me ask you about what's been happening in recent months, because I was just at a non-QM conference in Los Angeles a couple of days ago, and one of the words that was being used throughout that was the softening of the market. And I'm of the opinion it's not really a softening of the market as much as it is going back to original market, a more sustainable market. So two questions I have for you. What do you think has prompted all of a sudden sort of the skids on everything in the pandemic? Because I know everyone hasn't refinanced. I know people still want to move, and I know rates are still great. So what do you think has put the skids on it? And then where do you think the market is right now as we continue to finish out this year?
So, I mean, we use the word softening, I think right now it's exactly anything from last year's pace is going to look like a softening, right?
Yeah,
It was
different.
it was the best market in the history of mortgage banking.
Yeah.
So anything off of that's going to be softening. But I think there's a lot of factors. The COVID-19 situation is still having an impact, the political scenario, but what we have now is still great rates. I mean, you can borrow money at two point something or low threes. When you take a tax impact of that, that's really cheap money. But I do think real estate is a little lofty right now. I think real estate values have gone through the roof. I think customers are starting to get wise. I think there's not as much real estate for sale too, so that's slowed down that market. On the refinance side, I think some people are sitting back, saying that maybe I'll wait longer. Maybe rates are gonna get cheaper. Then you hear about, rates going up, rates going down. I have one basic premise. If it's time to refi and you can save some money, do it. You can always do it again, right? So waiting and trying to time the market is, but everyone is different. That's what makes this world, special place. Every person is different, and no one's right and no one's wrong. It's an opinion. So,
Yeah.
you got to value their opinions. You have to market to their opinions. And you're right. There's so much refinance still in the market, both in cash out scenarios, rate and term. I mean, there's a ton of business still out there, and
Oh,
it keeps
yeah.
coming in the door. It's not like it was coming in, initially in 2020, because we went from a higher rate, we dropped, and people were home. What are
Yeah.
you gonna do when you're home?
Yeah.
Well, I'm gonna listen to the marketing. I'm gonna listening to, hey, I got these bills, I got those, but I'm not working. I might as well try and refinance. Well, I can't refinance 'cause I'm not working. I mean,
Yeah.
it was just we never experienced that before, so it's all
Yeah.
new to us. It's all
No,
new to us. So
it
next year will be new to us too.
Oh, I think so too. Yeah. So what do you think is going to happen with values? And it's not even just values. I believe they're going to continue to go up, but and I think they're
Just
going to go up at a good
slower.
pace,
Yeah.
right? At a better pace, not such a dramatic pace. I don't think we're going to find they're going down, because there still is pent up demand. But
Yep.
what impact do you think in that is construction and material cost going to play in the building sector, and/or there's a lot of build to rent properties going up now. Builders are kind of putting the skids and recalibrating where their supplies are and redirecting them to different
Right.
places. Even homeowners who have equity are putting the skids on things because they may want to do a bathroom or a kitchen, but it's so costly, and you can't even, you'd have to wait 5 months for
Yeah.
a dishwasher to come in, right?
True.
So how do you think all of those external influences are going to impact the purchase market in 2022?
Well, I mean, if we have full employment or we have fuller employment, I don't think it matters what the costs are. I think people want a home. They want to go from a rental to a home. It's still the dream, right? So I think you'll get less of a house, but I still think, to your point, there's pent up demand, and I think there's a housing shortage. I think that there will, for the next probably 10 years, with the population, the millennials and the Generation Xers and everything else. I think
Combined homes. Yeah.
yeah, it's the dream to have a home, and you want to have a home. So I do think the roaring 20s, as we'll call it, is here to stay. I think the pace will be slower than it has been the last year or two. I think there'll be pockets of despair. There'll be pockets of one key factor we have not taken into account, and some people have, is the whole non-eviction and non-foreclosure process.
Yeah, yeah.
The foreclosure thing situation is always has some type of level of homes coming into the market foreclosures. We don't have that right now. So that's why we have less inventory. So that'll be back in the market probably next year sometime, once they get through the legal wranglings and things that have to happen.
And all of it.
I mean, we're getting back to full employment. We've seen the first, shoe drop where, unemployment's now no longer subsidized.
Right.
This foreclosure process will change too. There'll be rules around it. It will be a little more lenient, but there'll be more homes on market for it.
So let me ask you, I wanted to tell you this too. I have been calling these the 2020s, the soaring 20s. Because I really feel like this is the decade that things are going to soar in the mortgage industry. And I think those that have, really good, solid foundations are going to, last for a long time. I want to ask you a little bit more. I know I'm getting really technical with you, and we'll move on to other things, but I want to ask you a little bit about commercial, because you've mentioned housing shortage, and of course we know that. And you also mentioned that you've moved your company, right, into a different dynamic and not being in these, commercial facilities. We obviously have the big box malls that are in deep trouble, and hopefully we'll move into multifamily or something else. But what do you see happening with the commercial buildings that are in your neck of the woods in New Jersey and Philly and New York? What are you seeing as a transition for those types of properties to be able to solve the issue of pent-up demand and housing shortage?
The market was already softening well before the pandemic, as we know, in the commercial real estate. And there's still a tremendous amount of commercial real estate available, including the malls where you got things that are closing down. There's some vision and some talk about converting some of the malls to condominiums, taking them down and building some homes or rentals, wherever it may be. I mean, there's talk. I haven't seen anything actually happen yet, but it takes a lot of time, right? You got zoning laws, you got money issues, you got banks that have to get involved, you got liens already on the malls, you got REITs that are right in the public market. I mean, it's just a tangled mess. But I think if you took some of the space that's not being used appropriately or needed any longer, like a mall, as a good example.
Yeah.
It's a perfect environment because a lot of infrastructure over there, water, sewer, electric, gas.
Yeah.
It's perfect for a condo, apartment complex, something for, people that need, whether it be low income housing, whether it be, some areas high income
scale,
housing.
high scale.
So I think it's going to happen in this decade. I don't know when you'll start to see some projects take hold. But I still think the retail guys are, holding on to a thread, right? I still can make it. I can still compete against Amazon. I can still compete against the technology, although every one of them are online, right? And that's where most of the sales are coming from, is online.
Yeah.
So I think, is it going to be in my lifetime? Yeah, but it's going to take a little longer.
Yeah.
It's going to take a little longer.
Yeah, I think so. Okay, so let's switch directions and talk a little bit about the financing that you're seeing happening, as you go forward. And again, I just came from NonQM. NonQM happens to be, by the way, everybody agrees that we're changing the terminology of that now too. It won't be NonQM anymore, it'll be non-agency.
Okay,
but,
that's good.
It's coming. It's coming that way because everyone's saying, well, if it's not non-QM, then it must be subprime for those who remember that, right? And so it really isn't, because the credit scores, the performance, and the are equal to agency, and the LTVs are lower than agency. So there's actually less risk in those loans. So
all documentation, everything else is the same, right? It's more stringent collateral issues. I mean,
Yeah.
everything's good except for the documentation. How you
Yeah.
prove somebody's making money.
And and it's a growing environment. And so tell us a little bit about how you feel, or what your perspective, your crystal ball is moving forward in 2022 for what your team and your company is going to be looking at as far as expansion into the non-QM world, to help with the loan officers being able to find more deals.
Well, this year compared to last means deals are a little tougher. They're not as fluid. So a lot of borrowers have different stories, different ways they make money, but they can't document the right way. That becomes what we used to call Alt-A. Now it's
Yeah.
called non-QM, and in the future become non-agency.
Yeah.
I think the second home market and the investment market is being pushed to that market. It's a non-agency, right? Agency
Yeah.
only wants to buy 7% or 3% right now for many. Some are zero.
Yeah. Yeah.
That was just done all incorrectly.
Yeah.
But
And
I
I think
think,
that pendulum will swing back just a hair.
yeah, I had a meeting yesterday with the independent mortgage bankers,
Yeah.
and the conversation is such with the MBA that they think they're close to getting some relief on that from the agency. So when they say relief, they mean, maybe take it 3 to 7 or 7 to 10. But
Yeah.
there's going to be a cap on it, right?
Oh,
So
yeah.
the agencies secretly had a cap all along, but they never really pushed it down on people.
Right.
They just watched everyone individually. So that product, which is a big product, which is a lot of loans out there. I mean, the second home market and the investment market, boom, that was one of the biggest booms
Oh,
out there
yeah.
last year,
Yeah.
right?
And
People had the money, they wanted to
yeah.
had low rates, they
Yeah.
wanted to go
And the baby
investment income.
boomers, right?
Yeah.
It's our baby boomers. I'm a baby boomer. It's like all this baby boomer stuff that's happening. And so we're looking at investment opportunities and second homes right at the moment that we're in, approaching 60, right? And we're saying, hey, we need these extra homes.
You need yield, right? So
Yeah.
you go out there and say, I
Yeah.
could buy an investment property and make X dollars a year, right?
Yeah.
You do the math, oh, it's 10% return. Where are you
Yeah.
getting 10% today? You're not getting it.
Nowhere.
Unless you take a big risk. Now,
Yeah.
we as a society believe that real estate is risk-free for the most part. We
Yeah.
only had one time in our time that's really been bad.
Yeah.
So everyone still has, short memories, and they
Mhm.
say, let me go buy the house. Let me buy that one. Then they go up in value. Then all of a sudden the agency comes like, no mas,
Yeah.
no more. We're going to slow it down. And I think that market has slowed down significantly, both with available properties, the price of the properties, and lack of financing. So that has a major impact on, the slowing of investment properties and second homes. So, if I was personally buying investment properties or in second homes, I'd wait it out. I mean, I hate to
Yeah.
say it. I'm a mortgage
Well,
banker. I want
it's
to
gonna,
finance.
yeah, I mean, I would too. And I'm an
Yeah,
investor. I
yeah,
would wait it out right now because I'm waiting for forbearance, because
yeah.
as soon as it comes back, I think we're gonna have some big surprises. And I think that's gonna
Correct.
open up that marketplace, so to be ready, in that marketplace. So I want to shift gears as we continue this conversation, and talk about what's 2022 look like for your company and your sales staff, as far as, is it business as usual? Is there anything new that you're thinking about, as people are listening and saying, what is there that's out there that's fresh and new, or does it even need to be fresh and new for 2022? Oh, that's a good thing.
Yeah, I mean, for our company, we've evolved since last year before, where we have decided to hold on to servicing. So the company now has a $2 billion portfolio and growing. We used to sell it all off.
Yeah.
It opens up opportunities for people in the
Mhm.
portfolio that need cash, that want to buy a second home, want to buy investment properties, right?
Yeah, to
Or
hold
just
on
want
to.
to refinance. So that's one element of our business,
Yeah.
which we didn't have going into 2020. We accumulated it all in the last year and a half, and it's a phenomenal portfolio. The other thing we truly believe in, while we have very strategic branches around the country, and these are great men and women that have been doing it for many years, and they service, kind of like a broker, they service that local market really well. They don't have multiple states, they have one little area. We want to give them support. So the people coming in from the portfolio that may have worked with before, we're flushing them back to the branches. Number
Yeah.
two, we are setting up a CD unit or a consumer direct unit. So in the markets where we don't have physical presence,
Yeah.
we are going direct to consumer,
Mhm.
instead of the brick and mortar. We believe that the market over the next 10 years is less brick and mortar. We just got done talking about commercial real estate, and more, centralized, technology driven,
Yeah.
fast and quick, and get the borrow in, get them out, and move on. So we've got a consumer direct team now that does mostly refi.
Yeah.
The second unit we're putting together, quite honestly, is probably about half of it's going to be purchases, and then the market's going to change.
Right.
So that's the growth for us, is in the CD unit and strategic branches. And then where we can't complete the strategic branch, like I said, we'll do it on the CD side.
Yeah,
So
yeah. How much M&A do you think is going to be happening over the next couple of years with brokerages and wholesale and correspondent lenders? How much do you think is going to happen? You think there's going to be a contraction? You think there's gonna be
I,
expansion?
I think we've had a great deal of, you know, merger and acquisitions and contraction already, and it's still going on. But
Mhm.
I think it's been for different reasons now in the past than it will be in the future. I think the future will be more have to
Mhm.
merge, have to consolidate. The market's going to get slower. I think rates will definitely go up to some. I mean, you don't have many rates can't go much lower. I mean, it can go somewhat lower, but
Yeah,
the direction of the economy, if everything goes well and we beat this pandemic, is that we're already too low from a standpoint of where the market's
where
growing.
the
So
employment is. Yeah, you
yeah,
employment. Yeah,
it's employment and just, I mean, everything just says
yeah,
we've been keeping, our foot on the pedal here with rates. And I think some rates going up will slow things down to a normal pace, by the way. It's not going to be crazy
yeah,
bad. It's not
yeah,
going to be like, geez, I forget the year, maybe it was 2013, 14, I forget what year it was when it really slowed down. It's been
yeah.
that long. 19 slowed down, but not that bad. I think we need to kind of rattle out the cage and have some of the people who are in the business get out or consolidate. And I think that'll be a 2022 year. There's
Yeah,
always a chance that we,
yeah.
God forbid, don't come out of this where the pandemic gets worse and things get worse and we slow down, rates go lower. But I think the better chance that rates go up a little bit higher, and it slows the
Yeah, I
market
think
down
so
a little bit.
too. Yeah, I think
Yeah,
so too. And I think we have some aging, realtors, we have aging loan officers. I mean, the average
yeah.
person now, I think the average age is 57 now.
Wow.
It's gone up from 55. So, we have emerging millennials, emerging, younger people who are just more tech savvy. And I think a lot of people are tired,
Yeah.
right? And there'll
See,
be
that's why
some
consumer
attrition.
direct. I think
Yeah.
consumer direct is an answer.
Yeah.
There was a time period, then it went away, then everyone got
Mhm.
back to the branches. I think, with everything it's describing as far as the aging population, as far as consumers being younger and want technology, that's one of our plays. We've got some phenomenal technology that will allow the consumer to get approved online.
Yeah.
It's not every consumer, but it's a good portion of it, and move the ball very quickly.
Yeah.
Whereas, the branches are typically, local hand holding, take your
Relationship
application,
driven.
the
Mhm.
traditional way we did business, right?
Yeah.
Some of them are deploying technology on their own, some are not. Many are not. But the consumer direct side, we can manage a group together, opposed to all these branches that want to do it their way. They have a talent, they have a way to sell, and they make their clients feel very comfortable. Whereas that doesn't work for everyone the same way. But in a
Yeah.
CD environment, you have to be technology driven. You got to be fast on your feet. You got to be available for the people, and you got to move the ball very quickly. So
Yeah. Yeah.
that's the difference.
How do you think that competition is going to look like? If everyone, I mean, I know you're going into that, virtual environment. We have Rocket Pro, TPO, we have Quicken, we have a lot of different places they're doing. So what's going to set you aside? I mean, there's faster, but then, it's kind of like the movie when they said, 6-minute abs, and he's like, well, I got 5-minute abs, right? So, at what point will there need to be a differentiator that will elevate and shine a light on your company opposed to someone else?
So we've always differentiated ourselves because we can't compete with the big guys.
Mhm.
I've been part of big companies. I've been part of smaller companies. But the way we do business today is, family oriented. I mean, we're close. And to the consumer, you can get a hold of us, right? Loans come to my desk. You
Yeah.
don't find that in the big companies. A loan's not going to Dan Gilbert, and I know Dan. I
Yeah.
know Bob Walters and all the guys at
Yeah.
Quicken and Rocket and some of the other guys, and Bill Dallas. They don't see loans every day. I
Yeah.
do.
Yeah.
So we try and make exceptions. We try and do it things quickly. We try and understand the consumer's needs, and then we all get involved, and I think we just give better service and better listening than some of the big companies.
Yeah, that's good. That's beautiful. And I know that you're very community oriented as well. So tell us a little bit about that. I think that this is something that, and we know statistically, with the 5 generations that are all working together at the first time ever that that's happened, statistically, that the younger generations will leave a good paying job where they don't feel that they are serving the consumer the way that they want to. They will leave a good paying job and take a lesser paying job and go to a company who has a community or charitable orientation. So tell us a little bit about some of that you're doing, because I know that's near and dear to your heart.
Yeah, I mean, we can always do more. We have participated and been involved with the local Habitat for Humanity. I did a lot of work in California when I was at Bank of America and Countrywide, so I believe in it. I have personally done Open Doors Foundation with the MBA, where again, given some economic relief, volunteering my time. Even the local like my alma mater, we helped build the business school at Rowan University in New Jersey. So we go there to recruit people to come into the company, young
Yeah,
people who
absolutely.
want a different company, who spend time in their environment. And I have an open door. I say, if you have a good charitable idea, come bring it to me.
Yeah,
So can't say yes to everybody, but you listen, you learn, you get to know what the charity is, and you try and spread the wealth. And I think the key to us is that we listen. We're not going to be perfect, and there's people that donate more and have more involvement, but we listen to people and their ideas, and we try and stay local. um I don't know what else to say. To me, it's just, it's a natural thing of giving. If I've been brought up that way. So some people are, some people aren't.
yeah.
So they can't force people to do it. You gotta make them feel good about doing it, because if you're not gonna feel good doing it, then don't do it.
Yeah, yeah.
Yeah.
The word that you've used throughout this entire interview is listen. That,
Mhm.
and I would just say that's probably going to be your mantra, is listening. And I think that is a differentiator, especially when you can put your money where your mouth is when you do listen. There are people who
Yeah.
say they listen and then they don't, right? And
And
I
it
I
goes
think
right
that
over their
that's,
head, because
yeah,
they hear you, but they're not listening. There's a difference.
right.
I think
Big
I think there's a
difference.
difference. Yeah.
Yeah, big
Yeah.
difference. Yeah. Yeah, I know. I find that with my husband. He
Yeah, we
hears
get
me, but
accused
he's
of that.
not really listening.
I don't know. I think the husbands get accused of that selective hearing thing sometimes. I don't know.
That's right. That's
Yeah,
right.
but we're married a long time, so something's gotta be. We got to be
Yeah,
listening
something's right.
somewhere,
It's
right?
the not
Yeah,
listening, that
yeah,
works apparently. Yeah, yeah, for both of us. Yeah, that's really
yeah.
good. So, Kevin, if you wanted to leave us with just one thing to be thinking about, the people that are listening to this podcast are loan officers and managers and owners and real estate agents and investors. It's everybody who's in, and when I say investors, real estate investors, not so much our investors the way that we talk, but the people that are listening here. And what would you like to say to them, to give them something that today, when they finish this podcast, they say, I learned a lot about the market. I learned a lot about what EMM loans is doing, that charity may be something that I want to entertain. But what else would you like to leave with everyone as they are moving forward into 2022?
I think to be humble. We tend to get full of ourselves sometimes. We get so worked up in the moment, and there's a lot of money running around a mortgage company, and a lot of loan officers and people who can make a lot of money. And it's the people who make good money that are humble and polite and nice, that I believe that you get a butt up to. I mean, those are people that will be with you and will give you cause and give you purpose over the long term in your career. The second piece, which is just as important, is work ethic. You can learn whatever styles you want to learn. You can be, technically sound, But if you don't have the work ethic, if you don't plan on putting in the hours, you're not going to be successful. So, being humble and work ethic. That's the two things. I mean, everything else we can talk about, technical aspects of this secondary market, or what do you do in business and how do you do it? That's great. And it changes by the day. Two basic things: be humble and work ethic.
Yeah. Yeah. I love that. And notice I didn't ask you any of those questions because a lot of times it is that, I don't really want people on this podcast to be chasing shiny objects. It's not about chasing shiny objects. It's about, really centering and trying to figure out. It's funny. Yesterday I just did a recording for my coaching clients, and one of the things that I said is there's 7 strategies, or seven skills, or 7 things you can do that don't require talent to be successful. And that was one of them: work ethic. It doesn't require talent. It requires time and desire and drive. And those.
You gotta love what you do. I think loving what you do makes work ethic a lot easier.
Yeah. Well,
it brings you that you want to work, because I've been through it all. I was an athlete as a kid, right through college. I worked as a 12-year-old, in New York City. I was forced to go to do work as a young kid for my father. I was forced to, but I like to do it. I like to work down. I like working out for baseball and football. So I've been blessed that I liked the things I was doing. I had the ability to choose from them. And, I fell into mortgage banking in '86. I was
we all did,
we all did, right? And then I fell in love with it. So I had the passion for it, that I worked hard at it. So, but then again, I was brought up not to do anything else but work hard. So that's how, when I pick weeds in the garden, I work hard.
Yes. Yeah. Well, that's pride and that's integrity, right? Yeah. It's kind of like, how you do one thing is how you do everything.
Yeah.
Right. And that transcends right into the work environment and the personal life as well. So I think that's beautiful. Be humble and, get rid of the arrogance, get the chip off your shoulder, be humble, be a servant, listen to people and work hard to get where you want to go.
And you can do both very well. And I think people respect that and appreciate both of them. So
yeah, I think that's wonderful. Kevin, thank you so much for joining us today. Yeah, thank you so much. And so everyone, again, thank you so much for listening. And don't forget, scroll down on your phone and give us a great 5-star rating. And please leave us a review. We want the reviews to constantly come in. And be sure to ask your questions there. I periodically go in and look at those reviews. And if you have a question or a suggestion for a topic that you'd like to have discussed, put it in there or email me at jen@jenduplessis.com, and I will be happy to do the research, find the person, find the topic, and bring them here so that we can continue to help you grow your origination business. And so until next time, thank you so much for watching.
Thanks for listening to Mortgage Lending Mastery. Be sure to subscribe to hear more sales tips, ideas, strategies, and tactics to help you with your personal and professional growth to multiply your results in record time. And if you like what we're doing, don't forget to give us a rating and review so we can continue to bring you the best content possible. Wanting more beyond the podcast? Join our Mortgage Lending Mastery membership community, where you will find extended interviews with our favorite guests, weekly training, tips, and insider secrets, fireside chats with Jen, free content, meet, share, and collaborate with other members, and so much more. Click the link in the show notes to learn more about this exclusive content. Mortgage Lending Mastery is an Industry Syndicate charter podcast. Industry Syndicate is the first podcast network specifically for the mortgage and real estate industries. Get the Industry Syndicate app in the App Store or Google Play today.